Bismillahirrahmanirrahim. This is your lecture number 4, following the lectures about the interest rates and the behavior of interest rates. In the first chapter before this, we studied about the yield to maturity. And this yield to maturity we calculated on different kinds of financial instruments like simple loans, fixed payment loans, discount bonds, and coupon bonds. And then in the second chapter, following this chapter, basically we saw that how this interest rate is determined. We looked at that this interest rate can be determined with the help of demand and supply of the bond market. Like, we can see that what actually is the equilibrium price for the demands. And this equilibrium price we can find out through the interaction between the demand and supply of the bonds. And from that equilibrium price, we can calculate the equilibrium interest rates. The second theory that we talked about was the loanable fund theory, where we discussed that how much extra money is available with the people in terms of their savings and how much is the demand for that saving. So the supply of that saving was called as a supply of loanable funds, which people do when they actually want to earn interest rates on their savings. Similarly, the businesses generally need this extra money and they demand that loanable funds, and somehow where they both are willing to supply and demand, the interest rate is determined because the interest rate is the cost of borrowing and this is the incentive for lending. The interest rate is incentive for the lending for the saver and it is a cost of borrowing for the borrower. So both of them actually, decide at certain point, there is a certain quantity of the loanable fund, which the demanders are willing to demand at certain interest rates and suppliers are willing to supply at certain interest rates. So you can determine the equilibrium interest rate through the interaction of the demand for loanable fund and supply of loanable fund. The third theory we talked about was the liquidity preference theory. This liquidity preference theory was about the requirement of the liquidity, that how much cash people want to hold. This is based on the theory of Keynes, which actually is defined as that demand for the loanable demand for the money can be for 3 reasons. You want to hold cash for transaction purposes. You might want to hold cash for, say for example, like the precautionary purposes, or you might also want to hold cash for speculative purposes. So whatever purpose actually you hold cash for, you have to sacrifice interest rates. That is why the demand for cash or the demand for liquidity is an inverse function of interest rates. Whenever the interest rate goes up, the demand for holding cash decreases because that interest rate is an opportunity cost of holding cash. When the interest rate goes up, people hold less cash. When the interest rate goes down, people hold more cash. So if you define the relationship between the interest rates and the demand for money, you will have a negatively sloped curve. And on the other side of that demand for cash is the supply of cash or supply of money. And this supply is made by the central bank. The central bank's decision for supply depends on the economic conditions and economic considerations, and its stance on the monetary policy, that whether they are going to have expansionary monetary policy or contractionary monetary policy. So generally their decision for supplying money does not depend on the interest rates. So the supply curve for the money is in a vertical curve, which does not respond to the changes in the interest rates. And when we look at the interaction between the demand for money and the supply of money, so you can find out, this is a liquidity preference theory, you can actually find out a particular interest rate at which the demand meets the supply. And that interest rate is somehow we looked at that this interest rate can be the equilibrium interest rate in the market. Then in this particular chapter, we saw that how this interest rates varies when wealth of the people changes, when risk structure changes, when term structure changes, and there are a lot of things that actually changes. Now, what basically this lecture is about. This lecture is about the last bit of that particular lecture, that how your behavior changes when the time period for which you give or take loan changes, the risk that you bear on a bond changes. Like say, for example, some bonds are more risky and some bonds are less risky. Whenever you have got this kind of a condition that your bonds actually have got higher risk or low risk, your attitude or your purchasing of that bond or buying of that bond actually changes. So we are actually in this chapter are going to look at the risk and term structure of the interest rates. How much more bonds are demanded when the risk changes on the bonds, and how much is a rate, or how much is the rate when the risk actually structure changes, and how much the rate actually you have to pay when the term structure changes. By the term structure, we mean sometimes you buy a bond whose maturity period is 1 year, and sometimes you buy a bond whose maturity period is 2 year or 3 year or 5 year. This is a term structure. The longer time period the longer time period bond you buy, the higher interest you get. Or for the longer term, if you want to borrow, the higher interest you have to pay. Why this happens? And of course, this has got a kind of a very intuitive explanation. By the intuitive explanation, we mean there's a quite general explanation for this, that why people actually charge higher interest rates when they lend for a longer period of time, or why the people pay higher interest rates when they borrow for the longer period of time. The reason is quite simple, that because they actually freeze their money for a very long period of time, and that freezing of money basically, of course, is since it's for a long period of time, you are actually sacrificing your liquidity for a very long period of time, so you have to be compensated with a higher rate for the money that you are lending to other people. All right, so this particular chapter is about the risk and term structure of interest rates, how the interest rate changes with the risk, and how the interest rate changes with the term. Term means, again, the maturity period. Again, the interest rates on 1 year bond is generally less than the interest rate on 2 year bonds, and the 2 year bond interest rate is, of course, less than the 3 year bond. And similarly, the bond that are riskier bonds actually have to pay high. Like say, for example, if your rating is not very stable, or you actually don't have got AAA rating, you might not get money from the market at lower interest rates, because people do not want to take risk with you. Like as one of the examples we discussed in earlier classes, like one particular bond, if issued by Pakistan's economy and some developed countries' economy like Europe or UK or US, say for example, generally people want to buy the bonds from more stable economies, the bigger economies, and the economies where the economy does not basically fluctuate so much. So generally, if the Pakistan wants people to buy their bonds, Pakistan will have to give them incentive in terms of higher returns. So this is what something has got to do with the risk. So this particular chapter is an interesting chapter. It will be basically explaining you that why interest rates differ bond to bond. One bond gives you a return which is different from the other bond, and why this happens. And understandably, if a bond is different from the other bond in terms of the time period, in terms of the risk exposure, in terms of the denominations, there, of course, you will have to pay a different rate on that particular bond. So we first look at why bonds with the same terms of maturity have different interest rates. Sometimes, say for example, Pakistan is issuing a bond for 2 years, and the US also is issuing a bond for 2 years. But of course, the interest rate that you get on these 2 years bond from Pakistan and US will not be the same. Generally, the interest rate on the bond of Pakistan will be higher than the interest rate on the US bond, because US economy is actually has got a different rating from Pakistan's economy, or any country that basically has got better rating than our economy, or any company which has got better rating than one company which actually is issuing the bond, the interest rates will be different. So the relationship that we are going to study among these interest rates is called the risk structure of interest rates. Because if the maturity period of the two bonds is the same, the interest rate on these two bonds will be only different if the risk exposure of these two bonds is different. So we will be talking about the relationship among these interest rates, and we shall be looking at by looking at these relationships, we will be looking at the risk structure of interest rates. Okay, so as far as the introduction of this particular chapter is concerned, the relationship among interest rates on bonds with different terms of maturity is called term structure of bond. You cannot expect or you should not expect as a demander or as a supplier of the bond that you can borrow for longer period of time at low rate. If you want, like say for example, if you want to buy a car and you want to get your car financed, and you actually are getting some types of some kind of a policy from the bank, if you are willing to pay soon the money that you have bought for the money that you have borrowed for the car, you will be required to pay less interest rates. But if you want to pay or want to take longer term loan, like say for example, you buy a house by borrowing money from the bank, and you have a commitment with the bank that you will return this money within 1 year, 2 years, 5 years, 10 years, 20 years, 40 years, the higher will be the period, the higher will be the interest rates. Like say, for example, if you have bought a plan from the bank to return the payments that you have borrowed from the bank in the next 20 years, of course, your interest rates will be very high. And the banks, since the banks are going to freeze their money for 20 years, they will require to be compensated higher for this. So the relationship among the interest rates on bond with the different terms of maturity is called the term structure of interest rates. Term structure of interest rates. The period that the bonds which have got the shorter period of maturity, they actually pay you the less interest as compared to the bond with longer maturity. Longer maturity means the maturity period between of course higher than the lower maturity bond. So what actually are we going to do in this particular chapter? We are going to examine the sources and causes of fluctuations in interest rates relative to one another and look at a number of theories that explain these fluctuations. You will be having a different kinds of curves when you see that how the interest rates and term period are related to each other. Generally speaking, what kind of a relationship should exist between the interest rates and maturity period? Yes, positive, of course. But in some of the instances, this could be negative, which might be surprising for you. And it could also be a flat curve. So can you imagine the relationship between the term period and the interest rates as a negative relationship? Okay, who said this positive earlier on?
Sir, Aisha.
Yes, Aisha. Aisha, can you imagine this relation to be negative or a flat curve?
सर मुझे कोई एग्जांपल तो ऐसे समझ नहीं आ रही जहाँ पे इनका रिलेशन नेगेटिव हो.
All right. Okay. So it means that you can't imagine it to be a negatively related or flatly not related to each other. You mean by that, right? You only the other people I'm talking to as well. Perhaps the basic common sense relationship that comes to your mind is a positive relationship between the terms to maturity and the interest rates, because the longer period you borrow it for, the higher interest rates you have to pay. Okay, so I want you to imagine this relationship to be negative or a flat curve. Let's see what happens. So understanding term structure of interest rates. The term structure refers to the relationship between interest rates on bond yields and different terms or maturities. The term structure, when you say the term structure, the structures of the term or maturity period is defined. And when you define the term structure of the bond, you actually define the relationship between the interest rates on bond yields and different terms of maturities. When you graph this relationship, when you put the time period, say for example on y-axis, and the maturity period on the x-axis and the interest rates on the y-axis, when you graph this curve, this particular curve is called the yield curve. This term yield actually is used a lot in this particular kind of a literature, and yield means, what do you understand by this word yield?
Sir, the amount of time it would take for maturity.
Yeah, return, say for example, right? The yield means, like, say for example, a farmer, when he cultivates, does the cultivation, he performs the farming activity on his land. The output that he gets actually is called the yield of that particular land, yields per acre, or yield of that particular land that actually the farmer is actually doing cultivation on. So this yield curve is a kind of a relative actually understanding. This yield means the returns. Yield means the money that you get on the bonds that you buy or you borrow or you lend for a longer period of time. Okay, so I hope it makes sense to you. What does this term structure reflects? This term structure, as I have explained already to you, essentially reflects the expectations of market participants about the future changes in rates and their assessments of monetary policy conditions. What happens, as I was asking you this question earlier on, like when I asked that what kind of a relationship you imagine between the term period of a bond and interest rates on that bond. So Aisha told us, that we expect generally this relation to be positive, and that is what actually is a quite intuitive thinking or understanding of this relationship can be. But like the interest rates in the markets, specifically the bonds which actually have got the adjustable rates, do not remain the same. Sometimes the interest rates in the future increase, and sometimes the interest rates in the future decrease. It is not necessary that always the interest rates in the future increase. Sometimes when the countries basically have got kind of inflationary pressures, they reduce the interest rates on the banking loans and other kind of the loans. So somehow these loans basically, or interest rates actually affect every kind of a financial product. And similarly, sometimes in the future, the interest rates go up when the, say for example, the interest rates are it goes up when there's a fear of inflation in the future, and they can go down when the fear of deflation in the future or disinflation in the future. So this could be a possibility that in the future, the interest rates may go up or may go down or may also remain the same. All right. So if the interest rates in the future are expected to go up, you can have a positively sloped curve, the yield curve. But you might also expect these interest rates to fall over the period of time. Then only you will have a kind of a situation when you will be basically having the interest rates lower in the future than the interest rates in the current period. And similarly, you might also expect the interest rates to be same in the future. So you can have a flat curve, the flat yield curve, in the future. So in general terms, yield increases in line with the maturity. In general terms, yield increases in lines with the maturity, giving rise to an upward sloping, a normal yield curve. Now look at this curve. So this is what actually Aisha was talking about. And this is what a basic intuitive understanding of this particular relationship is. That if you are measuring the maturity periods on the x-axis and the interest rates on the y-axis, these interest rates are reading the spot rate. What do we mean by the spot and forward rates? I'm going to explain you in a while. So if you look at the rate at which the current rate, like spot rate, can we initially defined as the current rate of the bond. If you look at the interest rates, if the interest rates are increasing, like, I'm sorry, the maturity period is increasing, the interest rates on them is also increasing. Okay. However, they are increasing with decreasing rate, but still, like, you find some kind of a positive relationship between, like, the slope of this particular curve is somehow positive. Like, of course, it is getting a bit flatter and flatter because, like, say, for example, from one period to another period, the change is small. So this change is not big, like, this is. So this change is not big, like, say, for example, look at this change. This change is not big as compared to this change. So, but still, like, that the relationship between them is positive. So this positive relationship exists between the interest rates and the terms to maturity. The term structure of interest rates is the relationship between the different interest rates for different terms to maturity loans. So the curve plotted through the above points is called the yield curve. Now, what does these points show? Like this squares, what do these squares show?
Interest rate.
Yes, the yield on this, like, say, for example, how much you earn if you lend, if you like lend your money for, like, you increase your lending period from 1 to 2 year, 2 to 3 year, or 3 to 4 year, or 4 to 5 year. Okay, so this is what basically is happening here, and this is what is the basically the yield curve is called. So if we observe, R1 is the, like, say, for example, 8%, R2 is around 9%, R3 is 9.5%, R4 is 9.75%, and R5 is around 9.875%. It's a very specific kind of a calculation. You can have a rough calculations if you draw this curve on your answer sheets or your notebook. So then the current term structure of the interest rates is represented by plotting these spot rates against their terms to maturity. How long it will take for this bond to get mature. How long this bond will take to get your money back. So if this period is 1 year, you have a different rate, like, that you expect from the bond. If the period is 2 years, you expect a different interest rate. Similarly, the 3, 4, 5 period, like, that if that increases, of course, the requirement or the yield actually increases. Now, this was something I was initially discussing with you people, and I was giving you a situation that, like, can you imagine this yield curve to be negative or this yield curve to be flat? Now, there are possibilities always, like, say, for example, like as the possibility with every kind of a relationship that you have studied in your microeconomics and macroeconomics, that, like, say, for example, if the price of a commodity and the quantity demand of a commodity have got a negative relationship theoretically, but practically this can be positive, that can be flat, depending on the elasticity of demand, depending on the nature of the product. Like, say, for example, if you're talking about the Giffen goods, if you're talking about the Veblen goods, if you're talking about some goods which basically have got extraordinary different demand, you can have a situation where your demand curve is either negative, positively sloped, or flat curve. Similarly, the yield curve that you have, again, the yield curve explains the relationship between the term to maturity, how long this bond will take to get mature, and the interest rate on bond. It means that, like, if you invest or you buy a bond of some denomination for 1 year, your interest rates will be lower if your brother or some friend buys the bond for 2 years. All right. So this is what basically is a yield curve, but this can be upward sloping. The long-term yields are higher than the short-term yields. In the future, the yields are rising. So this is a normal slope of the yield curve and signals that economy is in expansionary mode. All right. So the economy is expanding. when the central bank wants economy to expand, what do they do? And the economy is increasing, so their returns are basically getting better. All right. So what happens with the downward sloping demand curves? The short-term yields are higher than the long-term yields, so dubbed as an inverted yield curve. And this signifies the economy is in about to recessive period. So you can have a kind of a situation where you basically have a downward sloping demand curve, and you can have a situation where your economy actually is not responding well, or it is not doing well. And similarly, you can have a flat curve where you have got very little variations between the short-term and long-term yields, and this signals that the market is unsure about the future direction of the economy. So the economy actually remains the same. All right. I am going to explain these all things in the upcoming slides. Now, if you look at the risk structure of the interest rates, the very first risk that you get exposed with when you borrow or you lend money to somebody, the first risk is the default risk. When you lend money to somebody, what is the first risk you expose yourself with? Is a default risk. What do you mean by the default risk? The default risk occurs when the issuer of the bond is unable or unwilling to make interest payments or pay off the face value. Like it generally happens with so many corporations, and even in some of the instances, it can also happen with countries. The countries can also default on their loans. Like, say, for example, if you borrow a bond of the government, you can be in a situation when the government denies you payments. The government doesn't pay you the money. And that is what basically can be a possibility. But this is a rare possibility. Generally, the corporations with higher risk exposure default. Generally, the people to whom you lend with higher exposure of risk default. It is not generally happen with the government bonds, but somehow, you cannot outrule this possibility as well. There are some instances in which the governments have defaulted on their loans. Like, say, for example, Pakistan has also reached to a situation where Pakistan's economy was about to default on their payments. So this is a possibility, and this was the possibility also in the Europe when Greece was about to default on its payments, but somehow the default actually is a rare kind of a situation as far as the government bonds are concerned. So the government bonds are generally treated as risk-free bonds. So, but I can't say that the risk of default on these bonds is zero. You can have some risk, but of course this risk is a lot smaller than the risk on the corporate bonds or some bonds which basically have got whose issuers are more unstable or more susceptible to losses. So US T bonds or Pakistan Treasury bonds or UK T bonds are considered default free. And the risk premium the people take is the spread between the interest rates on bonds and the default risk of the interest rates on T bonds. I'll be showing you that, the people, say, for example, how much how much extra risk people are taking from this corporations. The people basically charge premium for it. As you remember, we have discussed about it several times, that the companies actually there is a direct relationship between risk and return. If an investor is willing to take higher risk, he will be required to be compensated with high returns. You cannot force or you cannot attract investors for your riskier bonds if you are not willing to pay higher returns on it. Generally people sacrifice, or they basically are willing to take risks for higher returns. All right. Similarly, the liquidity, when you look at the risk structure of the interest rates, the liquidity also is a condition that actually defines that what kind of a return you will be getting on the bond. So the ease with which an asset can be converted into cash. And another consideration for the interest rates on the bonds is income tax considerations. Like say, for example, when you invest in certain bonds, when you invest in certain kind of investment plans, generally the government gives you tax, like, holidays, or tax, like, I'm sorry, rebates in the taxes. Not tax holiday. Tax holiday is a condition when the tax actually is waived altogether. Like say, for example, the tax holidays are given by the governments on IT industries and other kind of industries, and tax holidays actually means no tax at all, like, on the activities which governments want to encourage. But generally, what happens with your income tax rebates, they give you the rebate in the income tax. Okay. So you also, like, when you define or when you try to buy a bond, you always look three basic things: that the default risk, the liquidity on that bond, and the income tax considerations, that what kind of income tax considerations are. Now, say for example, what happens is, this actually, this is something, like what is happening here. Now look at the graph on your left hand side, sorry, and look at the graphs on your right hand side. Oh, what do you observe? If you look at these two graphs, the graph on the left hand side and the graph on the right hand side, if say for example the risk on the corporate bonds increases, if the risk on the corporate bond increases, what happens with the demand for the corporate bond?
Decrease.
Yes, decreases. From D1 corporate bonds, you go to the D2 corporate bonds. And the people who take their money out from the corporate bonds take this money to buy
Treasury bonds.
yes, government bonds, because they move their, like they change their portfolios, and they change the portfolio in such a way, like say for example, if that people are taking $100 million out from this corporate sector, the investments in the government bonds will increase exactly by that $100 million, or 100 million dollars, or whatever amount is being withdrawn from the corporate bonds will move to the government bonds. Now the price of the bonds will increase, so the return, overall return on the bonds will increase. Like I have been telling you that the interest rates and the returns basically are two different things. The return basically also includes the capital gains that you get, and that is something that you get basically before the loans basically are being paid. So if corporate sector wants to get this demand back or get these people back, what they will have to do, they will have to perform, they will have to give this risk premium. They will have to increase their rate by this much to get the people back and to get the demand of their bonds back. Now look at this graph. This graph is the graph that basically is defining the risk structures of the bonds. We have got certain rating agencies, we have got certain evaluators which evaluate the riskiness of the bonds. They, by their evaluation, they come to know and they find out how less risky or how more risky the bonds are. Now, if you look at the different kinds of ratings, like say, for example, first of all, look at the rating agencies. We have got different rating agencies which are respected all over the world, like say, for example, Moody's. And you would have also heard about Standards and Poor's and Fitch. Have you heard about these rating agencies? I hope yes, because like these are the rating agencies which actually rate all over the world different kinds of bonds and different kinds of investments. Like say, for example, the investments that are taken as the most secure investments, they give rating them, the rating which they give to them is generally AAA. If you are investing in a bond that has got AAA rating, you are investing in a bond that is the safest bond. The safest bond means it has got, like, the premium maximum safe, prime maximum safety, high grade, high quality bond. But if your rating is somehow, like, different, like say for example, different companies actually define these ratings in a different way. Like say for example, if you go to from AAA to AA, so you can actually expose yourself with the upper medium grade. Like, you don't have got higher risk, but like, of course, you can have got some risk. And if you are buying some bonds that has got triple B rating, I'm sorry, the B double A rating, or triple B plus according to Standard and Poor's, and triple B plus again stamp according to the Fitch. So you are actually having the lower medium grade. This bond is a lower medium grade. That this bond is upper medium grade, and this is a high grade quality bonds. So, like, and if you go further down, now say for example, if some of the bonds have got C rating, it means that they are extremely speculative and maybe in default, or like, the triple D is given to some companies, that triple D shows that, like, that company is already in default. There are few terms that you need to know before going to the further analysis. Like the first term is the spot rate. Spot rate, like say for example, as you know, the meaning of spot, at the spot. Like say for example, when you use the words at the spot, what do you mean by that? At the spot, at the same time, at the, like, at the very time, at the real time. The spot rate, like when you talk about different bonds have got different kinds of, like, rates. Like say for example, the current rate, the rate at which you can immediately trade an asset, this is called spot rate. And this spot rate can be contrasted with the forward rate. The forward rate is the future rate, the rate that you are going to get or pay in the future. All right. And the spot rate is the PEP rate at which you are paying to just at the current, like, the current market value at the spot. The spot rate is the price quoted for immediate settlement on an interest rate, commodity, a security, or a currency. At the same time, like say for example, you want to exchange a dollar with me with rupees. At the right now, what is the rate? You just give me the dollar, get the rupees with that rate. Similarly, like there are some other kind of the, like, transactions that happen, and that happen at the spot rate. Now the spot rate, also referred to as the spot price, is the current market value of an asset available for immediate delivery at the moment of the quote. So the value is in turn based on how much buyers are willing to pay and how much sellers are willing to accept, which usually depends on the blend of factors, including current market value and the expected future market value. Another term that you will be coming across very frequently, like, in this course or in other courses as well. And the other term is the forward rate. As perhaps the name suggests you, the forward rate means the future rate. A forward rate is an interest rate acceptable to a financial transaction that will take place in the future. These forward rates actually are really important. They are basically calculated on the basis of a spot rate. That is the rate at which the future transactions take place, or some kind of derivatives basically are traded in the market. So the forward rates are also very important, and they are calculated with the help of the spot rates. And they are adjusted for the cost of carry to determine the future interest rates that equates the total return of a longer term investments with the strategy of rolling over a short term investment. Okay. Now, there are three facts which give different shapes to these yield curves. Now, the facts theory of the term structure of interest rates must explain interest rates on bonds of different maturities move together over time. Interest rates on bonds of different maturities move together over time. Like, say, for example, if the rate on 2-year bond increases, the rate on 3-year bond also increases. If the rate on 2-year bond decreases, the rate on 3-year bond also decreases. And what actually this particular kind of a fact we shall be learning through the expectations theory. And what is that expectation theory that is going to come in the next slide. When the short-term interest rates are low, yield curves are likely to have an upward slope. When the short-term interest rates are low, when the short-term interest rates are low, the yield curves are more likely to have an upward slope. Because, say, for example, have you heard about the term of the market corrections? Have you heard the term market corrections? You know what happens?
No, sir.
Yeah, okay, I just explain you. Like what happens is that sometimes when the prices of something is very, very low, what do you expect it to be in the future? Like, you expect the price to go up. And similarly, sometimes the current prices are very high. Like, say, for example, you are living in an area where prices have reached to the top or to the highest level. Now, what will you expect in the future for these prices? Like, would you expect them to go further up or down? Something similar happened. Like, I'm just going to explain you what would you expect. Something similar happened in the stock markets. What happens is in the stock markets, if sometimes the price of a share increases too much, what people expect in the future and what should they expect in the future? If the price of a share has reached to a very high level, sometimes, like, say, for example, आप देखें जिस तरह रियल एस्टेट में होता है कि रियल एस्टेट में कोई एक ऐसा एरिया है जिस एरिया के अंदर चीजों की डिमांड एंड सप्लाई की वजह से कीमतें बहुत बढ़ गई हैं. एक्चुअली उसकी जो रियल वैल्यू है उस एरिया की, उसमें अगर एक मकान की आप बात करें जो कि 120 स्क्वायर यार्ड्स का है, अगर आप उस मकान की बात करें, सपोज उसकी वैल्यू होनी चाहिए 5 मिलियन, लेकिन वो ट्रेड हो रहा है 8 मिलियन पर. तो बहुत जल्दी मार्केट में करेक्शन आती है. बहुत जल्दी मार्केट में करेक्शन जब आती है तो उसमें फिर जो है वो दोबारा प्राइसेस जो है वो नीचे की तरफ जाते हैं. When your short-term interest rates are low, what do you expect to have in the long run?
ज़्यादा होगा.
Yes. And if the short-term interest rates are high, you expect it to be lower in the future. So when the short-term interest rates are high, yield curves are more likely to slope downwards because in the future you expect these interest rates to go down. आज मिसाल के तौर पर जब आपको पता है कि अभी कुछ अर्से पहले पाकिस्तान में जो पॉलिसी रेट था, that was 13.25%, and this 13.25% was very, very high interest rate as, like, for any country in the world. But Pakistan actually maintained for some time. Right now its policy rate is around 7.95%, 7.75% around. But like in the past, Pakistan's policy rate was around 13.25%. And what at that point of time people knew that the interest rates cannot go further up because this is already a very, very high rate. Do you know what I mean? So in that particular situation, when the interest rates reach to around 13.25%, the people and the government and the corporations were expecting these interest rates to come down. Something similar happens, and something similar is being explained in the point number 2 here in this slide, that when the short-term interest rates are low, you expect them to be higher in the future. And when the short-term interest rates are high, you expect them to, or you forecast them to be lower in the future. All right. So similar, like, kind of yield curves will be like, come to surface. Like, say, for example, if you are expecting the interest rates to increase in the future, your yield curve should be positive. And if you're expecting interest rates to go down in the future, your yield curve should be negative. And the third fact is that yield curves almost always slope upward. You know, like there could be a possibility that the yield curve might be negatively sloped. There could be a possibility that the yield curve can be a flat curve, but the generally almost what is true is that the yield curves are generally sloping upward. Like why that happens, I'll explain you that. Three theories explains these three facts, and these three facts, as I have mentioned you, that the interest rates on bonds of different maturities move together over time. When the short-term interest rates are low, the yield curves are positive. When the short-term interest rates are high, the yield curve can be negative. And like the third fact could be like, that yield curves are generally upward sloping. And there are some theories that explain these kind of behaviors. Like the first theory is the expectations theory. Expectations theory explains the first two facts. And these first two facts are that the interest on bonds of different maturities move together. And when the interest rates in the short-term bond is low, then the long-term interest rates will be higher. And if the short-term interest rates are higher, the long-term interest rates will be lower. All right. And the second theory in finance, which is called the segmented market theory, this segmented market. You understand segmentations of the market? The market segmentation actually happens when you divide your markets in different segments. Like say, for example, you divide your market on the basis of, I'm not talking about the financial products right now. Like say, for example, air industry defines or segment their markets on the basis of like, some travelers who travel in the economy, some travelers who travel in the economy plus, and some travelers travel in the business class. The K Electric segments the market, the commercial users, the industrial users, domestic users, and something like that. And there are quite a lot of segmentations available. And similarly, the financial markets are also segmented on the basis of the product and the nature of the buyers. The product, nature of the product, and the nature of the buyers. Sometimes, like, you have got different kind of markets which exist at the different places, and that is called the segmented market theory. Another theory is the liquidity premium theory. What does the segmented market do? Segmented market theory explains fact 3. This one. Yield curves almost always slope upward, but not the first two. The third is the liquidity premium theory. Liquidity premium theory. Do you know what do we mean by the liquidity premium? The liquidity premium is the premium that lenders charge for freezing their money for period of the time. Like say, for example, if the bond that you are buying is of very short-term maturity, if the bond that you are buying is of very short-term maturity, you do not if your bond you are actually buying for the short-term maturity, it means that you are expecting to get your money back very soon. But if some bonds actually have got the longer term maturity and you freeze the money for a longer period of time, you demand higher returns. अगर एक साल के लिए अगर आपसे कोई कहे कि आप मुझे एक महीने के लिए उधार दें, तो आप उससे इंटरेस्ट रेट कम चार्ज करेंगे बिकॉज एक महीने के बाद वो पैसे आपको मिल जाएंगे एंड यू विल बी एबल टू यूज इट फॉर योर ओन पर्पस. लेकिन अगर कोई आपसे कहे कि आप उसे 2 महीने के लिए लेंड करें, तो जाहिर है यू विल चार्ज more interest on 2 months loans than 1 month loan. The extra loan, that extra rate that you are charging is the liquidity premium. You are sacrificing the liquidity for 2 months. All right. So that liquidity, premium, you are sacrificing liquidity for 2 months. And similarly, if you invest for 3 months, you sacrifice your liquidity for 3 months. If you invest for 4 months, you sacrifice your liquidity for 4 months. So the liquidity premium theory combines two theories to explain all 3 facts. All right. So I hope you understand the liquidity premium. Premium means the extra charge that you have. Okay.
सर इसमें प्रोबेबिलिटी बताते हैं किसी लाइक प्रेडिक्शंस कितनी है कि कितना होगा लाइक व्हाट आर द प्रोबेबिलिटी शायद
जी जी, यू आर राइट रोहा, आपके माइक में काफी डिस्टर्बेंस है. You know, like expectations theory is based on the concept of mathematical expectations. What do these mathematical expectations do? You know about it, like, you know, say for example, if you are predicting about future, like you have learned about the averages. Have you learned about the averages? Say yes. Because, like, you know, the average tells you that what is the average of things that happened in the past. And similarly, when you find out this average for the future, the expectations theory basically tells you that what are you expecting in the future. Like, say for example, if you know about this expectations theory, this expected value of x is equal to what? Sum this is what, you know, like if you look at this summation x into px. Do you remember this?
Yes, sir.
Yes. And what does it tell you? It tells you that what are your expectations about the future on the basis of the probabilities of the future events. Like, say for example, if you are going to, like, you know, involve in some business, you can figure out that how much is the probability of getting this much profit and how much is the probability of getting that much profit. So you can, what you can find out, you can find out the expected future profit. And this expected future profit can be determined by, you know, like the kind of, you know, like by just multiplying the probabilities with the outcomes and taking their summations. All right. So the similar thing happens in this expectations theory. You try to determine and you try to forecast the average future returns of the assets. Okay. And how does this work? Like, let's see. Say, for example, the expectation theory attempts to predict what short-term interest rates will be in the future based on the current long-term rates. The theory suggests that an investor earns the same interest by investing in two consecutive one-year bond investment versus investing in 1 2-year bonds today. Like, say, for example, when you look at this example, you can find this out. Now look at this. Suppose the current rate on 1-year bond is 6%. Right now, the current rate is 6%, and you expect this interest rate on a 1-year bond to be 8% next year. आज आपका 6% है, next year कितना आप expect कर रहे हैं? 8%. So you will try to find out the average of it, and the average of that will be the 6% plus 8% divided by 2. What do you get? 7%. So you will be investing in 2-year bonds if and only if you are getting 7% return. The interest rate on a 2-year bond must be 7% for you to be willing to purchase it. So it means that, like, say for example, you actually, like, say for example, you are investing for 2 years. This year the interest rate is 6%. The next year you are expecting it to be 8%. According to the expectations theory, you will be like willing to invest if and only if you are getting 7% return, and this is 7 is an average of 6 and 8%. Does it make sense to you? Now you can see that this average will increase. This will increase if this increases. Suppose the future interest rates become 10%. Then what will be the rate at which you will be investing in a 2-year bond? That will be 6 plus 8, 6 plus 10, 16, 16 divided by 2, 8%. You will be only investing if the interest rate is 8%. I hope I am making sense to you guys. If you have got any questions, please do ask. So this is the formula for the expectations theory. For an investment of $1, IT is the today's interest rate on 1 year period bond, and expected interest rates for T plus 1 is the interest rate on a 1 period bond expected for the next period. T is the current period, T plus 1 is the next period. All right. And I2T is the today's interest rates on the 2-year bonds. And look at the formula here. I2T will be equal to what? IT current period and what is expected in the future divided by 2. And you can further extend this formula to any number by dividing the sum of those all interest rates with the n. Now, if you look at the expectations theory, it explains the term structure of interest rates changes at different times. And it also tells you that why interest rates on bonds with different maturities move together over time, because they are taken together in the average. So if the value of one particular period increases or one particular bond increases, the rate on the other bonds automatically changes. Like say, for example, if the interest rates on the 2-year bond increases, your first 1-year bonds will also increase. And similarly, if the interest rates on 3-year bond increases, the yield on the 2-year bond and 1-year bond will also follow the suit. It also explains why yield curves tend to slope up when the short-term interest rates are low and slope down when the short-term interest rates are high. Like say, for example, if you take the opposite, the current period interest rate is 8% and the future period interest rate is 6%. So you expect interest rates to fall in the future. इस तरह अगर ये opposite होगा, if this is opposite, like say, for example, the current period bond rate is 8% and the future rate bond is 6%. So the 2-year average will be 7%. So this 7% is less than 8%. Since this 7% is less than 8%, it means that what would happen that if your interest rates are higher and you are expecting this interest rates to be lower, like in the future, that will be lower. All right. Okay, so it cannot explain why the yield curves usually slope upward, which is effect 3, because it can be go upward, it can be downward as well. So it doesn't say that why it can be always upward. What is the market segmentation theory? I told you about the segmentations that the people do not treat all the bonds same, all the bonds perfect substitutes. They treat different bonds differently. They don't mix up the 2 bonds of 2 different maturities. They actually keep every bond separate. Like say, for example, what was happening in this expectations theory. In this expectations theory, we were combining the 1-year bond with 2-year bonds. And we were taking out their averages and we were defining or driving or we were actually deciding about our investments on the basis of the average of these 2 different bonds. But in case of the segmentation theory, this segmentations basically keep those markets segmented, these 2 markets separated. Like say, for example, if there is a market for 1-year bond and there's a market for 2-year bond, the 1-year bond will be different from the 2-year bond. All right. So that's what is an important thing. So it also says that the prevailing interest rates for short-term intermediate, the market segmentation theory is a theory that long and short-term interest rates are not related to each other because they treat the short-term bonds separately and long-term bonds separately. They don't combine them together. This particular theory does not combine the 1-year bond and 2-year bonds together. It does not combine 1-year bond with 2-year bonds or 3-year bonds or 4-year bonds together because it only that they keep them separated. Like say, for example, if you are doing the marketing and you are keeping the things like, if you are following the segmentation theory, you will keep different markets separated. Like say, for example, you will treat like say, for example, the market A different from the market B. Like say, for example, again, some of the companies make some unique like prime products, some quality products, some actually cheap products. So they make the market segmentation. They do not mix the market. Some of the companies make the average quality products. They basically follow the expectations kind of a theory. But some companies keep the market segmented. They define or they they make the products differently for the different people. All right. Like say, for example, it can make product for person A and for person B differently. All right. So this segmentation theory perhaps makes some sense to you. So bonds of different maturities are not substitutes at all. The interest rates for each bond with the different maturity is determined by the demand and supply of that bond separately. Not you don't add them together and find out the the long-term interest rates. Here you'll actually just find out the bonds on every different the yield on every different bond on the basis of its demand and supply. So investors have preferences for bonds of one maturity over another. If investors have short desired holding periods and generally prefer bonds with shorter maturities that have less interest rate risk, then that explains why the yield curves usually slopes upward. All right, so it's something is important. Another theory, which is the most popular theory, you may say, is a liquidity premium, or you may call it a preferred habitat theory. So when the habitat changes, things basically change. What does it mean? Basically, I'll be explaining you in a minute. So the interest rates on a long-term bond will equal an average of the short-term interest rates. Half of that particular theory actually uses the expectations theory, and something like they add the liquidity premium with the average returns of the bonds. The interest rates on a long-term bond will equal an average of the short-term interest rates expected to occur over the life of the long-term bonds plus a liquidity premium. This liquidity premium will be lower. What it will be lower for? किस बॉन्ड के लिए लिक्विडिटी प्रीमियम लोअर होगा? For which type of the bond this liquidity premium will be lower?
For long-term bond.
Short-term bond के लिए. देखिए short-term
short
bond जी. You will be charging less premium. You will be penalizing the company which is actually selling you the bond of short-term maturity by less, because you are going to get your money quickly back. Like say for example, if you have bought a bond of 3 days, 1 week, 1 month, 3 months, 6 months, and even up to 1 year, because in financial markets, the period, any period less than 1 year is called a shorter run. All right. So you should be understanding this. Bonds of different maturities are substituted, but not perfect substitute. Let's see what does that mean. Now, if you look at this formula for the liquidity preference, that what kind of interest rate you expect. So look at the first bit and look at this bit. And what is this?
Liquidity premium.
Yes, liquidity premium for n period bond at time t. So if the liquidity, you are freezing your bond or you're freezing your money for longer period of time, you charge higher liquidity premium. Now, what does this theory say? It says that investors have a preference for bonds of one maturity over another. They will be willing to buy bonds of different maturities only if they earn somewhat higher expected return on the longer term bonds. Investors are likely to prefer short-term bonds over long-term bonds because they prefer liquidity. They want actually to have cash with them. If they freeze their money, they don't want to freeze this for a very long period of time. They want to get it back, and that's what basically happens, that like when you just talk about this. So this is the, if you look at this area here, look at that area. This area is continuously increasing, and this is what the liquidity premium is. So you can read this. Okay.